Hello everyone, welcome to chapter 4 of the Access Cycle. In this chapter, we will be going over the intricacies and the details of integrating different concepts with each other separately. So, before we dive into this chapter, just to continue the trend, I want to quickly give you a little preview of what this chapter is actually about and why it matters. Okay, we will be going over the purpose or the objective of this chapter. Now, in the previous chapter, I basically laid out the step-by-step framework, the full process for how to approach the markets in a structured way. Okay, basically I gave you the procedural framework for what you do first, then what comes next, and so on. And we discussed all of that in a step-by-step manner. But this chapter right here is going to be different. This chapter is about integration. And what I mean by that is that now that you've actually learned about the frameworks and how they work together, the goal here is to show you how different concepts interact with each other and how they integrate with each other in real in-life market conditions. Okay, so instead of treating each concept like an isolated tool, we're now going to learn how they interact with each other and how are they integrated with each other or with one another in different conditions. Okay, and by the time you are done with this chapter, you should be able to answer questions like how to distinguish or how to tell the difference between a regular liquidity purge and a proper CSD, how to identify a high probability key level, how to identify a correct SMT divergence or how to confirm it, and so on. Okay, along with this, we'll have many other stuff too, but you get the idea. That's the goal here. Okay, this chapter is basically about refining your technical understanding. Okay, now let's get into the chapter. First of all, we will be discussing the intricacies and the details of order blocks. And within the next slide, I'll be helping you answer questions like how is an order block formed, what makes an order block valid, and most importantly, what makes an order block high probability. Okay, these are the three important questions surrounding order blocks, and I'll be showing you how to answer them or how to understand them in the next slide. First of all, let's break down how is an order block formed. Now, an order block is created in one of three ways, but regardless of which one it is, there are always two non-negotiable things or elements it must have. Number one, a specific type of behavior a candle or a group of candles must have. And number two, a candle engulfing that candle or those group of candles that had that behavior. Okay, that's basically the core structure. Now the behavior part itself comes in three forms. First of all, purging liquidity, or you could say a candle purging liquidity above a high or below a low. And when a candle shows that type of behavior, that could lead to that candle becoming a valid or a proper order block. And the second behavior that we have is filling liquidity. And filling liquidity basically means testing a key level. So when a candle or a group of candles tests a key level, then that is also one of the behavior that could lead to their formation. And the third one is generating liquidity, and that is basically when a candle generates liquidity in the form of a CRT or a candle range, and then that candle range gets engulfed or purged. That also leads to the formation of an order block. These are the foundations. Okay, now let's talk about the second question, which is what makes an order block valid? Now this question is also pretty simple and it can be answered through what we just discussed. Okay, for an order block to be considered valid, it must first of all show or display the specific price behavior that we are looking for, which is one of these three behaviors. And number two, be engulfed by a candle, which means that if a candle or a group of candles show one of these three behaviors, and then that candle or those candles get engulfed, that leads to the formation of a valid order block. Okay, and if either of these conditions is missing, then that's not a valid key level or a valid order block. Now let's move on to the third question, which is what makes an order block high probability? Now a high probability order block will have the following qualities or the following characteristics. First of all, alignment with the higher time frame directional bias, meaning it must be formed in the direction of the higher time frame bond liquidity, or it must be formed in the direction of the higher time frame directional bias. Number two, it is located in the premium region of a bearish dealing range or the discount region of a bullish dealing range, okay, depending upon the context. And number four, a high probability order block ideally forms at a key time. Okay, so when these four factors are present, they make up a high probability order block. Now the fifth factor that I should have written here, or the fifth quality, is that a high probability order block gets reacted to or gets tested at a key time. Okay, so if you have an order block on the 4 hour and price reacts to it at a key time like the 3 a.m. key time or 6 a.m. or 9 a.m., that also adds more probability to the order block working out, which makes it a high probability order block. And the reason this is important is because many candles could be counted as valid order blocks, but that doesn't mean that you should trade them all. Instead, what you need to do is only trade those candles or only build direction bias off of those candles or order blocks that have these qualities or characteristics present in them. Okay. Okay, so here I'll first of all give you some examples of valid order blocks, and then I'll talk about what it means to fill liquidity or what it means by filling liquidity. Then we will talk about an important idea within order blocks or within the selection of order blocks, which is when to choose the body of a candle as an order block and when to choose the wick of a candle as an order block, and what is the thought process or the rationale behind making that decision, or essentially how to do that objectively. Okay, and then after that we will talk about when to choose a single candle as an order block and when to choose multiple candles as a single order block. Okay, that will be the goal in this part of this chapter. So first of all, let's talk about what makes a candle a high probability or a valid order block. So the first protocol or non-negotiable or the first core component is that it must show a specific sort of behavior, and we talked about what those behaviors are. First of all, either it has to either purge liquidity, fill liquidity, and or generate liquidity. And once it shows one of these behaviors, the second thing is that it must be engulfed by a candle or a group of candles. Okay, so first of all, let's look at this price action right here. Right here you can see that price purged below this low. Okay, you can see that this candle along with this candle purged liquidity together below this low. So now you can see that these two candles together showed one of these three behaviors. The second thing that now we'll have to wait for, or we'll have to look for, is for price to engulf these candles or one of these candles. So first of all, you can see that price closed above here and closed above this candle along with this candle as well. So when these two candles as a whole got engulfed, these two candles together turned into a single order block. Okay, and then you can see price tested it and then we expanded higher. Now in this case, if you had chosen this candle as an order block, okay, if you had chosen this candle as an order block, then you would have been wrong. The reason for that is that price closed above these two candles together as a whole, which brings us to our next topic or our next idea, which is how to choose a single or when to choose a single candle and when to choose multiple candles in order block. And that boils down to how price closes above a candle or those candles. So if price had first of all closed only till here, okay, In this case, it closed right here above these two candles as a whole. But let's say if it had closed right here, then in that case, we would have chosen this as our valid order block in that case, and then we would have expected price to test it and then expand from here. But you can see that's not the case here. Instead, what price did is it closed above these two candles as a whole. So in this case, these two candles as a whole would have been the correct order block instead of the single candle that we have below. The next example we have is right here. You can see that this candle filled liquidity by testing this fair value gap or filling this fair value gap. This is what I mean by filling liquidity. This candle, you can see, tested this key level and filled liquidity inside this fair value gap. So now this candle, you can see, is following or showing one of these three behaviors, which is it has filled liquidity. The next thing that now we will look for is for price to engulf it. In this case, you can see that this candle right here closed above the body of this candle, which also brings us out to the next topic, which is when to choose the body and when to choose the wick of a candle as an order block. And that also boils down to how a candle closes above the candle that showed the behavior, or how the candle that shows one of these behaviors gets engulfed. So if price initially closes above only the body of an order block, then in that case you would choose the body of the candle as an order block. But if it closes above the wick, then you would choose the wick and not the body. Okay, so in this case, price closed above the body of the candle, so we would have chosen the body as an order block. Now let's say you missed this right here and price then closed above the wick too. So in this case, after this point on, right here, you would have then chosen this, the wick, the higher wick of the candle as an order block as a whole. Okay, and then after that point on, you can see that price also closed above these two candles as a whole. So now you can say that these two candles together filled liquidity. So then at this point, once price closed above these two candles as a whole, then you would have chosen these two candles as an order block. Okay, and this is how you choose and differentiate between selecting a single candle as an order block and selecting multiple candles as a single order block. Okay, it all comes down to how price engulfs the candle or the group of consecutive candles that showed one of the three behaviors. Okay, and at this point, when price closed above all of these consecutive candles as a whole, then at that point you would have chosen all of these consecutive candles as a single order block, and then you can see price tested it and expanded higher. Okay, this is basically the thought process behind choosing either a single candle or multiple candles as a single order block, and choosing between the wick and the body of a candle as an order block. Next up, we will be differentiating between different ideas and different concepts, how they differ from each other, what are the discrepancies between them, what leads to those discrepancies or differences, and what's the significance of being aware of these differences. Okay, in the next few slides, we will answer the following questions: how to distinguish between a valid CSD or a valid change in the state of delivery and a liquidity purge, and what is the difference between a regular market structure shift and a CSD. Okay, so first of all, let's discuss how to distinguish between a valid change in the state of delivery and a liquidity purge. So the difference between a CSD and a liquidity purge comes down to when they occur and where they occur relative to the drawn liquidity on your relative time frame. And what this means is that if price rejects below a low or rejects above a high before the relative drawn liquidity is reached, then that would be regarded just as a liquidity purge. But if that rejection below the low or rejection above the high occurs after the relative drawn liquidity is reached, then that would be regarded or considered as a valid CSD that would indicate a potential shift in the structure. Okay, right here, let me explain to you how to distinguish between a valid CSD and a liquidity purge. Now, the answer is obviously, I just told you, uh, when they occur and how they occur relative to the drawn liquidity on your relative time frame. So let's say you've determined that the drawn liquidity is here. Okay, so now based on this context, if the drawn liquidity is right here, you obviously know that the market is going to move higher towards this drawn liquidity and a bullish market structure. Okay, it's going to make higher highs and higher lows and break above highs and reject below lows. Okay, now this pattern or this price action that you can see right here could be regarded as both a valid CSD and just a liquidity purge based on the context. Okay, and obviously the answer lies in the context. You can't tell me if this is a valid CSD or a valid liquidity purge or just a liquidity purge without a context. Okay, both looks the same. It could either be a CSD or it could be a liquidity purge, and that depends on the drawn liquidity. So let's say if this if price broke below this low after the drawn liquidity was reached in this sort of fashion, then in that case or in that context, this would be a valid CSD and we would regard this as a CSD, and then we will have a structural shift and then we'll look for lower price action or lower prices. But if we have the same thing happening, but the drawn liquidity is not yet reached and the drawn liquidity is higher, then in that case, this would be just a liquidity purge, and from this point on, you would expect price to continue higher and have an expansion high. Okay, so this is just a simple concept and a simple idea. You basically have to look at the context and the relative drawn liquidity. Now, the second question is, what is the difference between or how to distinguish between a regular market structure shift and a valid CSD? So a CSD is a type of structural shift that happens after the relative drawn liquidity for your time frame is reached at a key time, and it is often accompanied with or coupled with an SMT divergence with a correlating asset. But a market structure shift is just a chart pattern that fails to distinguish between a true structural change and a simple liquidity purge. Okay. Next up, we will talk about SMT divergences, and we will be answering two important questions regarding SMT divergences. Number one, how to identify a high probability SMT divergence, and number two, how to confirm an SMT divergence. Okay, these are two important questions that you must be aware of. So first of all, let's talk about how to identify a high probability SMT divergence. Now, a high probability SMT divergence meets the following three core criteria or the following three core protocols. First of all, it is always aligned with the higher time frame directional bias, meaning it matches the higher time frame drawn liquidity or the higher time frame bias. Okay, the directional alignment is always that it's aligned with the higher time frame directional bias. Number two, it forms or occurs at a higher time frame key level. That's another characteristic or quality that leads to a high probability SMT divergence. And number three, a high probability SMT divergence forms or occurs at a key time. Okay, these are the three key characteristics that adds more probability to the SMT divergence playing out or forming out, which makes it a high probability SMT divergence. And the second question is how to confirm an SMT divergence, and that is, the answer is that an SMT divergence is confirmed when it is followed by a valid CSD or the formation of a valid order block relative to its lower time frame based on time frame alignment. Now let me show you some examples. Let's say we've got these two assets, two correlating assets, asset A and asset B. and they are moving in this sort of fashion. So right here you can see these two correlating assets and their price action. And let's say the context is that the drawn liquidity is higher on the higher time frame. Now right here you can see that in this case we have these two SMT divergences between these two correlating assets. Now even though we have this SMT divergence where this asset A failed to take out this high, whereas asset B took out the high, which led to the SMT divergence, but this wouldn't have been a high probability SMT divergence or a correct SMT divergence because it's not aligned with the higher time frame directional bias. And in this case, you would have just ignored it instead of assuming that now we are going to form lower price action, because the context here is that the drawn liquidity is higher. And even though we have these two valid SMT divergences, you wouldn't have regarded these SMT divergences as valid ones or correct ones, and you would have just ignored these SMT divergences. What happens a lot of time is that a lot of traders just look at these false SMT divergences and regard them as valid ones or correct ones, and actually give them more significance than they actually have, and dump their initial directional bias and just think that now we're going to have bearish price action because we have an SMT divergence, regardless of the fact that we still haven't yet reached the drawn liquidity on either of the correlating asset. And that leads to a lot of false signals and they end up losing a lot of trades because of it. Now in the next slide we're going to talk about time, which is an important topic, and we're going to answer an important question, which is how to approach time or how to approach key times correctly. Now this is an important topic because most people don't know a lot about it and they just treat time as a rigid framework. Okay, so let's move on to the next slide and let's discuss and talk about time. So in this slide, we're going to tackle and clear up a huge misconception around time or the time aspect of the charts, which is that almost all of you or way too many of you are still treating key times as some magical times where price is supposed to reverse or it is supposed to expand. But that's not how it works. That's not how key time works. Instead, the correct way to treat key times is to treat them as windows of opportunity or windows of time where you could execute a trade if all the other elements align, or where the probability of your trade playing out successfully is significantly higher. What I mean by that is that key times are just windows of opportunity. Okay, they're just periods of time where the probability of clean moves or expansions or reversals tends to be a bit higher if the other elements are also present. And that is an important part most of you miss. You don't just blindly trade a random pattern or a random setup because it's the London Open kill zone or it's 3 a.m. Instead, you only trade and execute if the other elements are aligned with each other. And then a key time or one of these windows of opportunity only acts as a validation factor there and just validates the whole setup. What I mean by that is that if everything aligns with each other at one of these windows of opportunity or one of these key times such as the 3 a.m., then the 3 a.m. part here in this case only acts as a confluence there and validates the setup. Okay, you don't just take a random pattern or a random setup as a trade because it formed at the London Open or because it formed during the 3 a.m. key time, and you think that because these are key times, prices just or that setup is just supposed to play out regardless of where or what the directional bias is, or regardless of the presence of a market context on the intermediate time frame. That's not how it works. Instead, you wait for all of the other confluences and elements to align together at one of these specific times or one of these windows of opportunity, and then you validate that setup by looking at whether it all occurred at a key time or not. So you can see that the time aspect here is only the last validating factor or the last validating confluence that only validates the setup by looking at whether it formed at a key time or not. Okay, it's only the last validating pretext there. It's not the actual reason which begins the idea. Instead, it only validates the idea. Okay, you wait for the other confluences such as bias, context, and entry model to align, and then you look at the time, and if it's a key time, then that acts as the last validating factor, and then you execute it. But if it's not a key time, then you invalidate that whole setup. Okay, the correct approach to key times or time is that you actively monitor during these windows of opportunities or during these key times. You set alerts at your key levels, and basically you wait for your bias, your context, and your entry model to align at the right time or one of these key times. And if that's the case, you execute. But if only the entry model or the context is present at the right time, then you don't execute because you still have to wait for the buys. You don't just take that trade because you have a context and you have an entry model and it's all aligned. It has all aligned at a key time, and now you think that it's now going to play out regardless of the buys not being present there or the buys element not being present there. Okay, that's not how it works. If all of them don't align and if either any one of them is missing, that means they are not aligning, and in that case you stay the fuck away from the buy and sell buttons, and you stay away from the charts and you don't execute. Okay, because the reality is that a key time does not create the setup. It only acts as a validating factor, and it just provides the backdrop where your setup is most likely to play out cleanly. Okay, price does not reverse because it's a key time or because of the clock. It reverses because of the other factors such as liquidity, key levels, buys, context, entry model, SMT divergences, and so on. Okay, and not just because of time. And what essentially I'm trying to say here is that when a setup plays out, it's not because it was formed at a key time. That setup played out and that was a high probability setup because of the other factors, because it was aligned with the buys, the high time frame directional buys, because it had a proper market context on the intermediate time frame, and because we had a mechanical entry model on the lower time frame. Okay, and time was only just a validating factor there, and that validated the setup because it formed at the right time. Okay, time wasn't the only reason because that trade played out. So here we've got another important topic, And this is a topic, an important topic that rarely ever gets talked about. And this one is also a little bit more nuanced and complicated than the other ones. And this is what I call exceptions. Now, up until now, everything that I've taught you so far has been about systemizing your edge. Okay, having rules, having conditions, having checklists, having frameworks and step-by-step procedures that builds or that helps you in building a systematic edge. Okay, but the reality is that the markets doesn't always move in straight lines, or you could say in that sort of rigid framework. Okay, they don't always move in directional sequences that your framework can neatly wrap around or that your framework can take a hold of. And what I mean by that is that sometimes there will be times where short-term moves appear that seem to completely go against the high time frame directional bias. Okay, sometimes exceptions to the rule appear in which short-term moves that go the short-term moves appear that go against the higher time frame directional bias. And if you don't know how to identify these exceptions, then you'll either miss trades that were valid despite them going against the higher time frame directional bias, or worse, you will try to force trades in an environment where you shouldn't force trades in the first place. Okay, you'll try to force trades that shouldn't be forced in the first place in that sort of environment. Now, a common example of this would be that, let's say, the higher time frame directional bias for the week is bullish. Okay, the drawn liquidity on the higher time frame, on the weekly time frame, is higher. And what has happened for the past 4 days is that price has continued to trade higher for the past 4 days from Monday till Thursday. And now today is Friday, and even though the higher time frame directional bias is bullish and the drawn liquidity is higher, and we have a bullish context on the 4 hour, what usually happens is that you try to take a bullish trade off of that 4 hour context, and what ends up happening is you lose that trade and price ends up going against the higher time frame bias and makes a counter shorter move on Friday. And that's basically an example of an exception where the market goes against the higher time frame bias. But remember, remember that these exceptions are not random. You can actually take advantage of them or by being aware of them because there's a proper logic behind them. And when you understand that logic, and when you understand the rationale and the thought process behind those short-term moves, your understanding of price action will improve even more. And then that way, you'd not only know when to take a trade, but also you'd know when not to, even when everything aligns. And that is what we're going to discuss here in the next few slides. By understanding these exceptions, it allows you to first of all improve your execution or have better execution, which means that you can trade those short-term setups against the higher time frame bias only when you know that these exceptions are clearly forming. Okay? And the second thing is that it increases your awareness or builds your awareness regarding these short-term moves. And because of this awareness, you'll start forcing trades in such market conditions or such market environments where these exceptions appear. For example, let's say that for the past 4 days, prices consistently formed bullish price action and it closed bullish on the daily time frame. Now on the 5th day, when you are looking for a bullish trade and you have a proper market context on the 4 hour and a proper entry model on the 15-minute time frame, you will stop yourself from executing that trade because you know that that's an exception. Okay, now we haven't yet gone through what are those exceptions and which sort of market conditions you're going to avoid it. We're going to discuss them in the next slide. But that is an example of an exception, and in that case you would know that because price has formed bullish price action for 4 days consecutively, on the fifth day you will avoid trading as a whole in the bullish direction, because you know and you've built this awareness that price action does not move in the same direction for 5 consecutive days. And then that way you not only just realize when to take a trade but also when not to take a trade. And exceptions basically highlight this difference between knowing direction and knowing time and place. Now in this slide, let's just expand on what we just talked about. In the previous slide I started talking about exceptions, but before I explain all of this to you, I have to make an important distinction here, and listen to this carefully. I want to make an important thing, something completely clear here, which is that first of all, how do we recognize when can we have an exception like this? And most importantly than that, how do we know that we are not just making shit up to justify taking an invalid trade in the opposing direction that doesn't make any sense? Because I know there's going to be a lot of you who might be thinking that, Sham, isn't it forcing trades, or isn't it justifying invalid trades in the opposing direction? And first of all, the answer to that is no. But more important than that, I know that this could lead to a lot of you forcing invalid trades in the wrong direction, which is obviously something I want you to avoid at all cost. And I'll be discussing my personal approach to that in the next slide. But I don't want you to come up with your own incorrect exception protocols just to justify an invalid trade. Okay, I don't want you to make up your own exceptions incorrectly just to justify trading invalid trades or taking invalid trades in the opposing direction. Like for example, right here we've got these exception protocols, and one of the exception protocol is the 4-day protocol, which says that after 4 consecutive days in one direction, price usually forms opposing price action or a short-term counter move on the next day. And this is an actual protocol. Now, what I don't want you to do is, I don't want you to do this thing where you make up your own protocol, like a 3-day protocol, and start saying that after 3 consecutive days of price action in one direction, price then forms short-term counter move in the opposing direction. Because I'm going to be completely honest with you, nothing like that exists. Nothing like a 3-day protocol exists. Okay? That's the most foolish and that's the most dumbest thing that you could do, which is making up your own protocols like this. If you make any other protocols apart from the ones that I've written down here, then that could be the most foolish thing that you can do. The only exception protocols that you must follow are the only ones that I've written here. And if you are wondering who came up with these protocols and these exceptions, then the answer is obviously ICT. ICT himself came up with these protocols, and you can find lectures on this on his YouTube channel. Okay, but essentially what I'm trying to tell you here is that only use these ones because these are the only credible ones that ICT came up with. Okay, and remember that do not come up with your own protocols, because trust me, you're going to lose a lot of trades and start forcing unnecessary invalid trades and start incorrectly justifying invalid trades if you come up with your own. Now let me break down these protocols for you. First of all, we've got the 4-day protocol, which basically says that after 4 consecutive days in one direction, the next day often produces a counter move, which basically means is that, let's say price has formed bullish price action for 4 consecutive days, then it's highly likely for price on the 5th day to form bearish price action in the counter direction. Okay, and that's absolutely true for price and for many markets, and you can basically look it upon the charts yourself. Okay, and it's really rare for price to form 4 days, or not 4 days, 5 days worth of consecutive price action in one direction. Okay, that is something that rarely ever happens, if not. The second protocol that we have is the weekly profile protocol, uh, which is basically that weekly profiles on news events can trigger short-term moves opposite to the high time frame buys. And what I mean by that is that sometimes due to the weekly profile structure, or let's say due to news events like CPI, NFP, or FOMC, we can form short-term moves or short-term counter moves in the opposing direction based on the specific context. An example of this would be that, let's say the drawn liquidity for the week is higher and the directional bias is bullish. And also let's say that we've got CPI news event on Wednesday. Then what usually happens is that on Wednesday, even though the directional bias is bullish, due to that news event, we sometimes form short-term move opposite to the higher time frame bias, and with that move we either purge liquidity or form a manipulation profile, and then on Thursday and Friday we continue that move higher and reverse from there and start to continue moving towards the initial intended directional bias. And that is an example of an exception protocol. And in that sort of scenario, what I usually tend to do is just avoid trading as a whole on that day and stay risk off instead of taking bullish trade in the direction of the high time frame directional bias. Another example of the weekly profile protocol would be the TGIF protocol, which basically says that if the weekly range expansion has already occurred and if it has already been established, then what usually happens on Thursday or Friday is that Thursday or Friday produces counter move or short-term counter move opposite to the higher time frame bias. And the logic behind that is based on the open high low close framework and many other concepts and ideas. And then the next protocol that we have is the Asian range protocol, which basically says that if Asia or the Asian range or the Asian session expands early during the day, then more often than not, what happens during the London session or the New Year session is that they often create counter price action to rebalance that range. An example of this would be that, let's say, if the Asian range or the Asian session forms an expansion in the direction of the higher time frame drawn liquidity early during the day, then during London Open, what happens is that London basically forms a retracement profile and retraces, and then during New York, after we've formed the OTE, New York then expands higher in the direction of the higher time frame drawn liquidity. So in this exception protocol, in this sort of scenario or context, you would have avoided the London session because, okay. Now, an important thing to note here is that these protocols are not standalone signals. Instead, you must pair them with other confluences and confirmations. Okay, they must always be coupled with other confluences and confirmations for them to be considered valid or credible or correct. So now that we've discussed the exception protocols and what the main ones are, now let's talk about what to actually do with them or how to deal with them when you spot an exception protocol. Now, after confirming an exception protocol or recognizing one, you could either do one of these two things. First of all, you could either trade it, meaning you trade the short-term move against your high time frame bias. You go ahead and take the short-term move against your high time frame bias, but you only do that only if it's backed by a proper context on the 4-hour and there are proper confirmations on the lower time frames. And in that case, you could trade it. And the second thing is that you stay risk off and stay flat and skip trading in either of the direction, skip trading both directions to protect your capital. Okay, these are the two things, or these are the two options that you have when you've spotted an exception protocol. Now, personally, my personal approach is that I choose to avoid trading entirely on such days. Okay, personally, I don't trade on these days at all because honestly, I know that these kinds of moves are messy and they are much harder to manage. Okay, the risk of over trading or getting trapped in these sort of moves is much higher because you are trading against the bigger picture, and the chances of getting chopped up in consolidations or baited into bad entries is way higher. Okay, and I believe that in these sort of contexts or scenarios, preserving consistency and mental clarity is much more important. Okay, because I know that my edge isn't just built on being right. It isn't built on being right all the time. Instead, it's built on following my edge, which basically involves showing up every day with clarity, with control, and the most important one, with discipline. So I'd rather miss a trade by avoiding by avoiding trading these sort of days than miss up my mental flow for the rest of the week. Okay, that's my personal approach to it. Now, my recommendation for you would be that if you identify such exception protocol, when you identify an exception protocol, the safest and the most consistent approach is to just avoid trading that day on that day as a whole. And yes, you might miss one day of opportunity, but also you'll avoid unnecessary losses. You will avoid the mental drain and basically protect your edge over the long run. Okay, and that's the best thing that you can do, that you could do in that sort of scenario, because your goal is not to win every single day. It is to stay in the game long enough to stack weeks and months of high quality executions, and that sometimes means sitting away or sitting out of scenarios and context and market conditions like these ones.